Did you know that over 70% of first-time investors lose money in their first year? Not because the market hates them, but because they unknowingly sabotage themselves. But here's the secret. The difference between a failed investor and a successful one isn't luck, it's knowledge. And by the end of this video, you'll have the blueprint to dodge these disasters and invest like a pro, even if you're starting small. Mistake 1. We've all seen it. A friend, a forum, or that one finance guru on TikTok promising the next big thing. Maybe it's a meme stock or a coin that's going to the moon. The problem? By the time you hear about it, the insiders and early investors have already made their profits. What's left is a pump and dump trap waiting to burn your cash. Example: in 2021, Dogecoin's hype turned early investors into millionaires. But thousands of latecomers, lured by viral tweets, bought at the peak and watched their investments crash by over 80% within months. Pro tip: do your own research. Use tools like company earnings reports, annual financial statements, or apps like Yahoo Finance. If you don't understand why you're investing in something, that's a red flag. Remember, if it sounds too good to be true, it probably is. Mistake number 2. Trying to time the market. Everyone thinks they can outsmart the market. Buy low, sell high. Easy, right? Wrong. Even professional traders with years of experience and advanced tools can't consistently time the market. Trying to guess the perfect moment usually means you either miss the big gains or panic sell during a dip. Example: imagine investing $10,000 in the S&P 500 in 2003 and leaving it untouched for 20 years. You'd have over $64,000 by 2023. But if you missed just the 10 best days during that period, your returns would drop nearly in half. Pro tip: focus on time in the market, not timing the market. Dollar cost averaging, investing a fixed amount regularly, reduces risk and takes emotion out of the game. Slow and steady truly wins here. Mistake number 3. Ignoring diversification. You've heard the saying, don't put all your eggs in one basket. Yet many beginners dump all their cash into one stock or one sector, thinking, this is the next Apple. But if that stock tanks, your portfolio crashes with it. Example: in the early 2000s, many employees of Enron invested their retirement savings entirely in Enron stock, only to lose everything when the company collapsed. Pro tip: diversify across sectors, tech, healthcare, energy, and even asset classes like bonds, ETFs, or real estate. A simple way for beginners: use a low-cost index fund like the S&P 500 or a total market ETF. That way, you're spreading risk without needing to analyze dozens of stocks individually. Mistake number 4. Letting emotions drive decisions. The market dips. Panic sets in. You sell everything, only to watch prices rebound days later. Sound familiar? Emotional investing is one of the costliest mistakes. Fear and greed can blind you to long-term strategies. Example: during the COVID-19 crash of 2020, the S&P 500 dropped 34% in just over a month. Many panicked and sold at the bottom. But those who stayed invested saw the market recover and reach all-time highs within months. Pro tip: create an investing plan and stick to it. Set clear rules. For example, I will hold for at least 5 years, or I will not sell based on daily news headlines. Use tools like stop-loss orders to protect your portfolio without emotional decisions. Remember, volatility is normal, but panic is optional. Mistake number 5. Neglecting your education. Investing isn't a one-time decision. It's a lifelong skill. Too many beginners think they can wing it or rely on luck. That's how people fall for scams, chase hype, or mismanage risk. Example: take the 2008 financial crisis. Millions of investors held risky mortgage-backed securities they didn't understand. A little education on risk and diversification could have saved fortunes. Pro tip: spend at least 30 minutes a week learning. Watch credible finance channels, read books like The Intelligent Investor, or take free courses on platforms like Coursera. The more you understand, the more confident and profitable your decisions become. Remember, investing isn't about getting rich overnight. It's about building lasting wealth brick by brick. Avoid these 5 mistakes, stay consistent, and your future self will thank you. If you found value in this video, smash that like button. It really helps the channel. Subscribe for more smart money tips and drop a comment. Which mistake have you seen people make the most? Let's help each other grow smarter, together. Thanks for watching, and I'll see you in the next video.